Hello, Premium Hunters. It's Andrew here to give you better options. I've been trading options for over 25 years and I consistently generate over $5,000 a week with my options trading. And I'm here to pull back the curtain to show you exactly what I do and exactly how I do it, so that if you are interested in options trading and repeating the types of returns that I generate, you can learn from what I do. And here is my update for week 5, which is January 27th through the 31st. So just before I get started, a disclaimer here that I am not a financial advisor, and the information in this YouTube channel is for educational purposes only and should not be considered financial advice. Please consult with a qualified financial advisor before making any investment decisions. So why am I doing this? Well, first, if you're new to options trading, I want you to know that it's legit. I'm giving you the opportunity to see real results from a real trader. I'm documenting these trades in real time so that you can see that they are real. And my second goal is to build a community of like-minded people who are interested in options trading. Anyone from newbies to those that have been trading options for years or decades. Options trading is a complex topic and there's so much to learn. So here's what I cover in these videos. Now I have made some changes and I'll likely continue to do so. This is a relatively new channel and I'm still kind of tweaking things, trying to figure it out how to make it as effective for my audience as possible. So if you have any suggestions or recommendations on what I should be covering and how I should be covering it, please write it in the comments section below. Now, last week I made some changes where instead of showing you a bunch of numbers in a table format, I started showing you my trades in a graphical format. I was showing the stock chart and annotated the stock chart of my trades to provide a visual representation of my trades, which I think is much easier to understand and much more effective at explaining the strategy. And I'm going to continue with that trend. But another change that I am making this week is I've decided to leave out the new trades that I'm placing each week and just jumping straight into the trades that I've closed for the week. Now, if I just happen to open and close a trade in the same week, which does happen quite frequently, then I will be covering open trades as well. But for those trades that were opened and not closed, I'm not going to be covering those, and that's mainly for the sake of time. And I think my audience will learn much more from the trades that I've closed rather than the ones I've opened. So as you see here, I will be covering the strategies that I've closed, the goal for those strategies, and the profit and loss for each one of those strategies, and then covering a performance analysis. And then I will go over my weekly performance, comparing it to previous weeks to see how I am tracking from week to week. And from there, I will give any insight that I've gained from analyzing these trades. Now, just a reminder that I will be releasing future videos about how I do these trades in more detail with a step-by-step on how to execute them yourself. So definitely, if you haven't already, like and subscribe to the channel and hit that bell notification so that you can be notified when I upload these videos. So now that you know what to expect, let's start with taking a look at my performance so far this year. As you can see, I started out with just over $4,000 in week 1, $6,000 in week 2. I did have a loss in week 3. I did book a loss, although technically it's just due to timing. If you took all of the associated trades and took the profits and loss of all of those associated trades and put them together, then I would have had a profit on all of those associated trades. But because this is a week-by-week analysis of these trades, technically for that week I did show a loss. I am recording each week as they happen, and that's how that particular week happened. Week 4 was the best week so far with a profit of $7,404. And so how did I do in week 5? Well, stick around and find out. So week 5, January 27th through 31st, I did have 11 trades, and let's take a look at them. All right, so the first trade here is on the gold's futures, which that's what GC stands for. That's the ticker symbol, gold futures. And this is a series of strangle trades. And just to give you an idea of what you're looking at, this is the stock chart for the gold futures. You can see the timeline down here, and you can see the price scale over here. These solid horizontal lines are our options trades. And they are straight lines because when we sell an option, we are selling at a particular strike price that does not change for the entire life of the option. So as we can see here, we have a call option, that's what the C stands for, at a $3,070 strike price right here. And this is the expiration of that option on March 26th. So this is one trade that was paired with a put of $2,095. And so when we sell this trade, we collect a premium that if the stock stays between those two strikes by expiration, we get to keep that premium. So there are actually two strangles here. There's one with a put of $24.95 and a call of $30.70, and then another one with a put of $25.10 and a call of $30.90. The first one with the call of $37 and put of $24.95 ended up closing on January 27th with a profit of $1,865.88. The second one closed on the same day, actually, with a profit of $561.96. Now you might be wondering, why is the first one so much more profit than the second one? The answer is simple. I had sold 6 contracts on the first one, and the second one was only 2, and that was mainly because I only had so much capital to tie up, and I didn't want to exceed my limit of capital that I tie up in trades at any one time. So 6 on this one, 2 on that one, which is what explains the difference. And then once I closed the second strangle, you can see here that I opened a third one with a put of $2,500 and a call of $3,200 expiring on April 24th. And that one is still open, which is why it's displayed in yellow. All right, so that's the first trade. Let's move on to the second one. All right, so this next trade is in Amazon, as you can see by the ticker symbol, AMZN. And this is my most frequently traded strategy, which is the weekly wheel. That's what the WW stands for here. And don't worry about the L2. If you want to learn more about how I trade the weekly wheel, first start with the Wheel of Fortune video that I have linked to the description. And I will be coming out with how I trade the Wheel of Fortune as a weekly trade in an upcoming video. So stay tuned. But essentially, don't worry about the L2, which stands for level 2. This is a put that I sold at the $230 strike price. And what happens here, this is when the trade was opened. This is when the trade expires. And it's a flat line because the strike price of $230 does not change throughout the life of the trade. When I sell the option, I collect premium that if the stock price stays above the put strike price, I get to keep that premium. But what I do is I put in a good till canceled order, which will automatically close the trade if it hits a 50% profit. So it never goes to expiration, or very rarely. Typically it's going to close out before expiration. If it ends up going below the strike price, which is what we call in the money, then I will have to buy the stock at the strike price. The owner of the option is going to exercise the option because they get to buy at current market value. So if it is below the strike price, they get to buy at a price below the price that they can sell it to me for. So as you can see here, after I sold the put, the stock price stayed above the put price, which is what I'm looking for. However, right here on the 27th, it dropped below the strike price. And this was when they had the news about DeepSeek hitting the market and causing investors to panic sell. I never worry about those kinds of things. And when I come out with the video about how I trade the weekly wheel, I will explain why I don't worry about those kinds of things. But it's good that I didn't worry about it because, as you can see, the stock price rallied back up above the strike price. And then the very next day, it rallied even more to a point to where it closed out at a little bit more than a 50% profit at $730.41. At which point, so at this point right here where this arrow is and you see the profit of $730, that's when this trade closed out. It never, as you can see, it didn't go through expiration. So once that trade is closed out, I immediately open another trade, and this trade was opened with a strike price higher than the previous trade. The previous trade was at $230. This one was at $235. And the reason I do that is because the further away the strike price is from the stock price, the less amount of premium you're going to be able to collect. So I have to move that strike price up and down along with the stock so that I can collect more premium. So as you can see, when the stock price went higher, so did my strike price for the put that I sold. And as you can see on this trade, on the very same day, it ended up closing for that 50% profit at $670.42. At which point you see a yellow arrow below this line, and that's because this is another trade, but it's at the same strike price. So in order to differentiate this being another trade, I have a yellow arrow here. And as you can see, the stock price dropped down below my strike price of $235, but then rallied back up again over the $235, at which point I was able to collect $484.43. So as you can see here, stocks tend to fluctuate up and down. They don't typically go in a straight line up or a straight line down. They typically fluctuate. So while a stock is fluctuating, I am making profit in both directions as compared to somebody who bought the stock. And if they bought the stock here, then they're going to be not so excited right here. They would be excited here, but then again here they're not going to be so excited because it came right back down to the price that they bought it at. They might start getting excited here, but the stock's probably going to come back down again. And all the while they're watching their profits come and go and come and go, I'm booking profits and watching my account size grow the whole time. So as soon as this trade closed for the $484 profit, as you can see, I opened another trade, but with this strike price being a little bit lower at the $232.50 strike price. And this one expires on February 27th, which is why you see the arrow because it's off the chart. But this trade is still open, and we'll see how we do on that one next week. All right, so let's move on to the next trade, which is in Google, and this is the same strategy. It's the weekly wheel. I sold a put for the $195 strike price, and as you can see, this was sold on the, looks like the 22nd, and as you can see, the stock fluctuated around a little bit. It broke down below my strike price, ended up coming back up to the strike price, riding the strike price for a little while, and then rallying, at which point I was able to book a profit of $454.40. As you can see, I did not put on another trade for Google, and the reason for that is, as you can see down here on the stock chart, the E indicates that it's going to be announcing earnings on the 5th of February. And earnings is what we call a binary event, meaning that it can cause the stock to move drastically in one direction or the other. I don't care which direction it moves in, I just don't want it to move too far because that can lock me into losses. And there's no reason to take that risk of locking myself into losses when I can just wait a week, and on the 5th, after we see the results of earnings and after we see how that impacts the stock price, then I can go ahead and continue doing my weekly wheel on Google. All right, so let's move on to the next stock or the next trade, which is Planeteer. This is also a weekly wheel, and as you can see, I opened this trade, which was a put at a $78 strike price. The stock price was quite a bit higher than $78 and moving in that direction, but then as soon as I sold the put, the stock started selling off and came down well below the $78 strike price, but then started rallying again and went above the $78 strike price, but then started selling off again and came back down to the $78, but then rallied again, at which point I was able to book a profit of $185.20. Immediately I opened another put at $77 strike price, and it has been rallying, but not enough for me to book my 50% profit. So this trade is still open, and we'll see how that one does next week. This one is also a February 7th expiration. Now, the next trade we have here is a little bit of a different situation. This is in Tesla, obviously, as you can see. This is a bit of a different situation because I bought shares of Tesla way back before they started exploding, right around 2019. And I have a pretty good number of shares that has given me the ability to do the trading that I'm doing today. And because Tesla has a tendency to go up and down, it's a pretty volatile stock. There are times where it goes up, there are times where it goes down, and there are times where it just basically trades sideways for a while. And while it's trading sideways, I like to sell calls to generate some extra income on that stock. Well, just recently, towards the end of 2024, I sold some calls on Tesla, as you can see, at around $250 per share. And then the stock started running up on some news about the advancements that they were doing in AI. And so that put me in a position at either having to sell the stock at a price well below the current market value. Now, mind you, the calls that I sold aren't on all of my shares. It's just a fairly small portion of my shares, so I didn't put all my eggs in one basket. But at the same time, I do not want to sell these shares at a lower than current market value. So I have the choice of selling the shares at a price well below current market value, or I could buy the calls back at a pretty significant loss, or the other option is I can roll those calls forward in time, and I can keep doing that perpetually pretty much forever. There's no end to that. So that's one of the nice things about options trading, is that in most cases you never really have to show a loss. The problem is that every time you roll forward that trade, you are tying up that capital that cannot be used for other trades. So even though technically you're not showing a loss, you're kind of taking a loss because you're not generating returns on that capital. So what I'm doing is I'm rolling these calls forward in time. I'm taking a credit every time I roll these calls forward in time, which is helping me make up the difference between the current stock price and the strike price of these calls. But that's going to take a long time. That's a pretty big difference. It's a difference between $404 and $255. That's going to take a long time to make up that difference. So the other thing that I'm doing to help increase the speed of making up that difference is selling puts. Now, if the stock drops below my put price, I may have to buy the stock at that price, but I'm really not too worried about that because I don't mind owning Tesla stock. I actually want to own the stock. I do own the stock. And so I am using that strategy to help make up that difference even faster. So I know there's a lot of information here and it looks very busy, and that's because a number of trades were put on at the same time. But let's take a look at what happened here. So as you can see, I sold a cash secured put for $360 for a $360 strike price, which closed out here on January 29th for a $3,643 profit. And you can see that I immediately sold another put at a $355 strike price since the price was a little bit lower from where I sold it back here. And that one ended up closing the same day for a $1,018 profit, at which point I opened another trade at the $360 strike price. This was another put at $360 strike price. And the reason why it's a yellow arrow, it's indicating that this is a new trade that was opened at the same strike price. And this trade was closed the very next day for another $1,668.55 profit. At which point I turned right back around, sold another put for $370 strike price, and that one is still open, and that one expires on the 21st of March. So as you can see here, I was able to make some pretty good profits in a very short period of time, and that is helping me close the gap in the cost basis between the $400 current stock price and the $250 current strike price. So yeah, it's going to take some time to fill that gap, and it's going to make it harder if Tesla starts rallying again, but at least I'm doing something to generate some income to help offset that loss. All right, so let's go ahead and move on to the next trade, and I believe this is the last one. Now this is a credit spread. Now this is a credit spread, which is a new type of trade which I've not gone over so far in this video. And a credit spread, the spread means that there is a spread between one option and another option. There are two options in this position. There is the PCS stands for the put credit spread, which consists of a short put and a long put. So here we see a short put at $430 strike price, and here we see a long put at a $420 strike price. We are selling a put, collecting premium, and then we are using some of that premium to buy a put down here. So this is a bullish to neutral position, which means we want the stock price to go up, or it can go sideways, or it can even come down a little bit. And that's one of the great things about options trading, is that when you buy a stock, you need the stock price to move in one direction up in order to make money. But when you sell options, the underlying asset doesn't have to go in any direction. It can actually stay right where it is, and a lot of times that's the preferred outcome. But at the end of the day, the stock price, like in this situation, the stock price can move up, it can move sideways, and it can even come down, and we're still going to make money. Because what happens here, as the stock price comes down, the value of the long put that we purchased goes up, which offsets the losses of the short put. So this is what we call a defined risk strategy, meaning that we are limited to the amount of loss that we can take on this trade as compared to a naked put or a short put that we've sold without a long position to offset the loss. So let's take a look at what some of these numbers mean. This BE stands for the break even. And So on this particular trade, the break even is $427.69. So if the stock price at expiration came down to $427.69, we would break even on this trade. We would not make any money, would not lose any money. It would be break even. And below that is where we start experiencing a loss. The max loss on this particular trade is $12.31. Now that is per contract. Now this max loss is actually at the lower level here, and between this lower line and this break-even line, it's going to be somewhere between 0 and $12.31. So it's not like once the stock price drops into the red zone, you're taking a max loss. No, you will start taking a loss that will get larger and larger as it drops, and then the max loss is $12.31. Now, on this particular trade, I did take a $545.33 loss, and you might be wondering, well, why did you take that loss? Because you were still way above the profit zone. There have been studies done by the Tasty Trade team that have shown that it is always best to close out these positions, or at least manage these positions, at the 21 days to expiration. And going beyond 21 days to expiration, you're not going to fare any better. And that has to do with the Greeks of the trade and how options are priced. They've done extensive backtesting to show that at 21 days, you either roll your position forward, which is what we refer to as managing, or you just close it out and you take your trade, you take your loss or your profit and move on. And so that's what I did here. This is the 21 day. I actually closed this out on Friday, which was 21 days prior to the expiration date, and I took my loss of $545.33. Over time, my profits are going to outweigh my losses, and I know this, and that's why I'm not worried about this $545 loss. All right, so that's it for the trades. Let's go ahead and move into our profit and loss table to see how we did for the week. Let me explain what we're looking at here. The first column is the symbol for the underlying asset. So here we have /GC, which is the gold futures. The strategy was a strangle. The profit and loss for this trade was $1,865.88. It was open for 30 days, which gave us a profit per day of $58.31. And that gave us a return on capital of 6.04%. The return on capital is just a ratio between how much profit was made compared to how much capital was tied up in order to generate that profit. And then if you annualize that 6%, that would give us a 68.88% rate of return if we were able to duplicate this trade for the course of a full year. All right, so let's go through each one of our trades. The next one was the other gold futures trade where we made $561.96. And then the Amazon weekly wheel, we made over $730. Another Amazon weekly wheel where we made $670. The Google weekly wheel, which we made $554. The Planeteer weekly wheel, which we made just over $185. This is the cash secured put in Tesla where we made $3,643. This is the trade that we lost, $545, which was the credit spread. The Amazon weekly wheel where we made $484, and the cash secured put in Tesla where we made just over $1,000, and then the other cash secured put in Tesla where we made almost $1,700. And then that's it. Let's go over our totals for the week. These are average numbers, so our average annual return on capital was 93.04%. Our annual monthly return on capital, or actually our average return on capital was 1.72%. Our average profit per day was $352.62. The average number of days for each trade was 18 days, And then our total profit was $10,738.05. So overall, it was a great week. It was actually our best week so far. Let's take a look to see how that stacks up against our trades so far for the year. And as you can see, we outperformed every week so far by a pretty wide margin. And our totals for the month of January, the first month of the year, and for the year so far is $27,571 with an average monthly income of $5,514. So we're off to a great start so far for 2025. Let's hope that that continues. We'll see what happens with everything that's going on in the political arena right now. It's making things a little sketchy, but I truly believe that this is the best way to generate income on a consistent basis. So that's it for this week's update. I really appreciate you stopping by to check it out. If you have any comments or questions, please write them in the comment section below. As I mentioned earlier, I'm looking to build a community and I would love to hear from you. If you like this content and you want to learn more about options trading and you'd like to learn how to implement these strategies for yourself, then I highly recommend you like, subscribe, and hit that bell notification because I will certainly have more content coming out to show you exactly how I put these trades on and a lot more foundational information about options trading itself. But that's it for this week. Thanks again for stopping by, and I look forward to bringing you better options in the future. Bye-bye.